Alright, what's up everyone? Welcome back to Compound Interesting. This is Emil, and in today's video I'm not going to do another stock analysis like I usually do. I wanted to do a quick market update and my opinions on the market right now, whether I think the market's undervalued or overvalued or fair valued. So in this video we're not going to go through all the kind of more obvious points. I want to kind of give you a new perspective because I'm sure you're blue in the face of hearing about how unemployment numbers are affecting the market and the Fed and money printing, blah 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 blah. I'll just mention those briefly, but I want to give you some new perspectives and some new insights that you might not have heard already. So the last time I gave a market update, I'll link the video up here. I said I thought the market would come back down. So this was probably a month or so ago. So when the market had started coming back up from its really steep crash, it's had a really steep crash and started going back up. And I said the more likely scenario is the stock market goes back down. But I was wrong in that case. However, I did say that I would continue buying stocks because I didn't know whether the market would go up or down definitively. So I continued to buy stocks even though I thought the stock market was going to go down. So I'm obviously happy I did that as the stock market has roared higher. So in today's video we're going to have a look at a lot of charts, particularly with normal valuations, particularly with in regards to the stock market. So the one you're probably most familiar with is the price to earnings ratio, and that's the one on the screen right now. And this is the most commonly used valuation metric out there. So it compares the price of the market compared to the amount of earnings it generates. So currently the price for the S&P 500 is 22 times the amount of earnings that it's creating. So as you can see, it's in this metric, it's slightly overvalued compared to historical amounts, although it's severely undervalued if we compare it to 2000 in the dot-com bubble and also in the 2009 crash where earnings really crashed. Earnings were basically close to zero during the 2009 crash. But overall on this metric we're definitely overvalued, but maybe this isn't the best metric to be looking at. So I was trying to get to sleep last night, and of course my mind is racing about stocks because that's all my mind thinks about these days. And I really struggle to get to sleep. So let me know if you have those troubles again as well about, what investments I need to make. But I was thinking last night, I was like, okay, the price to earnings ratio of the S&P 500 is definitely higher than normal. Usually we want it below 20. As you can see historically, it's usually, this is for the last 100 years though. So in the last 30 years, it's kind of always been over 20. We've had some quick dips under 20, but for the most part, it's been over 20. And now we're at 22. So for more recent price history, the stock market isn't crazy overvalued, but over the last 100 years, it's definitely overvalued. But what I was thinking last night before I could get to sleep was, okay, we're definitely overvalued on a price to earnings ratio, but a lot of big tech companies and a lot of companies in the S&P 500 don't earn very much money. For example, Amazon, which makes up 4.5% of the S&P 500. So 4.5% of the market cap of the S&P 500 is Amazon. And Amazon's price to earnings ratio is over 100. It's 118. 5% of the S&P 500 is made up of Amazon, which has a price to earnings ratio of 118. So obviously that's going to be skewing the S&P 500's price to earnings ratio. Whereas previously, before, let's say, the dot-com bubble, we definitely wouldn't have these high-tech, high-growing industries with such crazy high price to earnings multiples. Now to add to that, it's not like Amazon would be a bad investment. A lot of people still buy Amazon, and Amazon still has a lot of buy ratings because it's growing so fast and it's so enormous and it's so useful for everyone. And there's other companies that are also skewing the market in the last 20 years to the upside. So I think on a better metric to look at rather than the price to earnings ratio is the price to sales ratio. So I was excited to see what the price to sales ratio historically has been in the S&P 500. And to see if we were at a fair value or undervalued or overvalued. And as you can see, we're actually overvalued. So quickly, a price to sales ratio is the price of let's say the S&P 500 compared to the amount of revenue it generates. So not earnings. So earnings are basically profits, but revenue is, because Amazon, for example, all this revenue is reinvested into the company. It doesn't really have any earnings. It doesn't keep any money, it just reinvests it to grow the business. So I thought the price to sales ratio would be a better metric to see whether the stock market is overvalued or undervalued. And as you can see, we're actually definitely overvalued also in a price to sales ratio. So we're even higher than we were in the dot-com bubble on a price to sales ratio metric. Okay, here's another chart of the price to sales ratio over the last 20 years. So this one's a bit better because it starts at zero. In the last slide, it looks like we're more overvalued than we actually are, because the last slide doesn't start at zero. It starts at 0.6. So it looks more volatile than it actually is. Always be aware of that when you're looking at charts. Does the chart start at zero? Because if the chart doesn't start at zero, it kind of skews the graphic. It makes it look different to what it actually is. Anyway, that was a bit of a sidetrack. But just to add to that point about Amazon, I think before like the dot-com bubble or anything like that, we didn't really have those huge, enormous tech companies that are growing so fast, like Google, Amazon, Facebook. Like these are the biggest companies in the world, Apple, but they're also still growing really fast. Before the 2000s, the biggest companies weren't really tech and they weren't really growing fast. Like the biggest companies maybe grew 5%, 5 to 10% a year. Nowadays, the biggest companies are still growing 15% plus. Google's growing 15% a year still. Amazon's growing 20% a year. Facebook 25% a year. Some around that. Apple's growing lower, about 10% a year. So those big tech companies are growing faster. So faster growth always means a higher price to earnings or price to sales multiple. So that's just one reason you have to think about and take into account when you're looking at the S&P 500's price to earnings or price to sales ratio. The big tech companies are growing very fast comparatively to the biggest companies in the world previously. Faster growth equals higher price multiples, because people are happy to pay more because they know those earnings and revenue are going to grow. As we know, markets are forward looking, so they're not looking at what's happening right now. They're looking at what's going to happen in anywhere from 3 to 5, 10 years. And the growth in the stock market over the last number of months took into account the eventual flippening and the job growth that was sure to come from the massive unemployment drop. And now in the last week, the unemployment numbers actually rose. So more jobs are being created than are being destroyed right now. And the market has already taken that into account. And I think this trend is set to continue, as we lost so many jobs a couple of months ago. And obviously this is because the economy is reopening. All those people who lost those restaurant jobs, airline jobs, eventually they're going to come back, and they're going to continue coming back for the next number of months until we get back to those normal rates that we had. Another couple of bullet points, then I'll give you the bear points, and make sure you stick around to get my overall opinion on the stock market and whether you should be buying or selling or holding. I'll leave a timestamp to that if you want to skip to my opinions on the stock market. Well, as we know, interest rates are zero. So if you're buying bonds or treasury bills or government bonds or whatever, the interest rate is pretty much zero. So you basically give them your money and they hold it for you for 5 years and give you back the same amount of money, which is pretty much useless. So why would anyone do that? Or even negative interest rates, which might come soon and are already there in Germany and other places in Europe. But I give you $1,000, you hold it for 4 years and you give me back $900. I don't know who in their right mind would want to do that. But basically we have no idea how stock markets perform or react to negative or 0% interest rates. Theoretically, valuations can go to infinity because people can borrow money for nothing, put it into the stock market and make a return, and they can just borrow as much as they want because they know they don't have to pay back more than they're borrowing. So valuations in these kind of times have to be higher, but unfortunately we don't really have anywhere to look at in previous times where we had 0% interest rates. So we don't know how high the valuations can get in the stock market because people can't really get a return anywhere else. And people want to hedge against the enormous amount of money that has had to be printed to deal with the COVID-19 situation. People want to get a return for their money, or at least the $1,000 that they have now will buy them the same amount of goods that they could buy now in 10 years' time. They want to hedge against inflation, and the stock market could provide that hedge. That's why we've also seen the likes of gold going up and Bitcoin also going up. The Fed in America also mentioned that if worse came to worse, they were kind of hinting that if the stock market kept dropping, the Fed would actually buy stocks, or they weren't going to buy stocks directly, but they were going to be buying stocks through an indirect way, which made it federally legal, but they essentially were going to be buying actual stocks. The Fed was going to print money and buy stocks if worst came to worst. So people were like, okay, if I buy stocks now, my risk is much lower because the Fed, if the stock price drops a lot, the Fed will buy it. So there's kind of a bottom Like, you're not going to lose 100% of your money if the Fed is going to save all stocks in the stock market, theoretically. And the Fed never had to do that, because just by saying that the Fed would do that, people, or the Fed just said they might do that or were considering it, but people saw that and were like, okay, investing in the stock market is now risk-free. I'm just going to invest loads of money. So the Fed, just by saying that, pumped the stock market loads. And the last couple of bullet points, obviously the COVID-19 situation seems to be improving. There's less deaths every day, and it's kind of somewhat sad, but everyone who is really vulnerable to COVID-19 and catching COVID-19 in nursing homes, and a lot of them have already passed away. So respect to them, but I think the numbers should continue decreasing, and a lot of the most vulnerable people have already passed away or made it through to the other side, and thus have the antibodies to the COVID-19 situation. This is not a happy thing, but it's just a fact. So I'm not saying this is a good or a bad thing, and this is just a fact, but it is quite sad. But it does mean that there's less dependence on the economy. A lot of people who were vulnerable to COVID-19 were elderly people who weren't monetarily contributing to the economy, and with them passing away, it means there's less dependence on the economy. So that's just a fact, unfortunately, but it does mean that the economy does have less dependence in the future. Okay, so let's go through some potential bear points. So the first one is not for certain, but I'm just speculating that a lot of people who are trying to hedge against inflation have put all their, or the majority of the cash that they wanted to deploy into the stock market, they've already deployed it into the stock market to save their purchasing power, if you will. So I think now there's less available cash to deploy into the stock market than there was previously. People aren't really waiting on the sidelines with loads of cash as much, but that's just a speculation. There's no way to really know that. Now, the more obvious bear point is that the valuation of the stock market is overvalued in every single metric comparatively to historical amounts. So every single normal valuation metric says the stock market right now is way overvalued. So let's have a look at, for example, I showed you the normal PE ratio. The Shiller PE ratio is kind of a more fair price to earnings ratio. I'm not going to go through exactly how it works, but this is more indicative of where the market actually is. So as you can see, also on the Shiller PE ratio, we're extremely overvalued. So almost at that Black Tuesday level, but not quite at .com bubble levels. So it does look like we're in a bit of a bubble in the Shiller PE ratio. And here also we can see that according to the Shiller PE ratio, we're in an extreme bubble. At the same time, for the last 20 years, the stock market hasn't been at a fair value, except once at the very, very bottom of 2009, the 2009 crash. We've always been overvalued, and stocks apparently have always been in a bubble pretty much for the last 20 years. So I don't know how reliable this is anymore, because if you hadn't invested for the last 20 years because stocks were in a bubble, then you would have lost out on some serious returns potentially. So what I've been doing, and what I'll probably continue to do for the rest of my life, is buy stocks. And I'm extremely disciplined. I buy the same amount every single week, no matter where the market is. If it's up or down, I buy the same amount every single week of different stocks, which is, for me, it's €150 a week. So that might be nothing for you, or it might be a huge amount for you, but for me that's actually quite a lot. But I try to stick to this amount every single week. I stick to that as a minimum. If I see great deals, then I'll buy more, but I always try to buy the same amount, even if I think the stock market is way overvalued and I can't really find any stocks at all. And there's a few reasons why I do that. Firstly, you've got to acknowledge your own ignorance. No one knows where the stock market is going to go. Just like me a month ago, when I thought the stock market would go down, I continued to buy stocks because I don't think I'm smarter than I am. I always think, in regards to the market, it's like trying to predict the weather. You can't really do it. It's very, very difficult, and it's kind of just a guessing game. So it's much better to dollar cost average. So the technique I use is a blend between dollar cost averaging and buying the dip. As in, whenever there's a dip in a stock or in the entire market, I'll increase my buys a bit as it's dipping or as it's going back up. But then in times where the stock market is fair or overvalued, I'll just be buying my €150 a week. Another reason I'll buy stocks, even if they're potentially overvalued, is because I'm young, and If you're also young or have at least 20 years left in the stock market, then you shouldn't really care if you're buying stocks. You shouldn't be buying obviously at crazy high valuations, but if the stock's a little bit overvalued, but it's a great company that will definitely be earning way more money in 20 years time, then you should still think about buying it, because you could be waiting for it to come back to fair value for a long time, and periods of overvaluation can last years and years. So if I'm waiting for the stock to come back down to a fair value, the stock will keep going up because it will keep being overvalued. So I could have bought here, but now the stock's up here, and then finally we get back to fair value. But now fair value's here, but I could have bought it here. So I've missed out on all these gains. I'm buying here. So let me just show you a couple of graphs. So this is buy the dip versus dollar cost averaging. So if you had dollar cost average since 1980, you would have done better than buying the dip, the perfect dip every time since the same time. This happens because of what I just told you. If you're always waiting for a dip to buy, you could be waiting a long time. And in this scenario, they're getting the exact perfect dip every time, which you will not be able to do. You don't know when the bottom is in, so you won't be able to buy the perfect dip. So this is why dollar cost averaging, the technique that I use, buying the same amount every week, is far superior. This is buying the dip if you knew exactly when the dip was, and knowing exactly when the dip was is next to impossible. To do it every single time, like is shown in this graph, is impossible. To do it a few times, yeah, maybe that's possible, but dollar cost averaging is more than possible. Just buying the same amount every week, and you have to come up with the correct amount for you. So I always try to keep a little bit cash on the sidelines just in case of emergencies, or if there's a real sale on stocks. But for the most part, I'm deploying most of my cash into the stock market every single week. And this is the reason. It's because buy the dip usually beats, dollar cost averaging usually beats buying the dip. Now, if you had bought the dip perfectly for the last 20 years, you would have done a little bit better. But as you can see, both charts are pretty similar. And I think dollar cost averaging just requires a lot less stress on your mind and trying to wait for the right opportunities. It's much easier just to dollar cost average. And so you can focus on finding great companies rather than trying to predict economic things like I'm explaining in this video. Well, you have to do whatever you want, but what I would suggest for my little brother is to dollar cost average. The majority of your money should be dollar cost average, and maybe keep a little bit on the sidelines for a company that you really believe in and that has taken a really big tumble. Overall, in regards to the market, I think the market is going to continue going up, but I think the returns over the next number of years will be low, probably in the 5% range, because we're at such high valuations already. So when the market is in high valuations, the returns are lower, and vice versa. So as you can see on this graph, this doesn't go up to 2020, but if it did go up to 2020, we'd probably be at a similar level to where we were in the dot-com bubble, like pretty high up there. So this is an inverted graph, so the returns are in percentages. So as you can see in the dot-com bubble, we have a negative 5% return, and other periods are averages around 10%. So I'd say we have, at the moment, we probably have a positive return of about 5%, which is pretty crap normally. However, when you compare that to putting your money in a bond, it's amazing, because bonds get 0% at the moment. So yeah, I think the stock market over the next number of years is more than likely to go up. And I think in the short term, I think we have seen the bottom of the stock market. I don't think we're going to go lower than the March lows that we had a couple of months ago. I think that was definitely the bottom. Like, I think something extremely drastic I think people who are waiting around for another big dip might not get the big dip that they want, and definitely not below those March lows anyway, or even close to them. We could get a dip, but I don't think it's going to be that severe unless the COVID situation comes back even stronger. But I think even with a second wave, I don't think we'd reach those lows again, because we've already dealt with it and we know how to get through it, and we've kind of already gotten through it. So the last thing, if you're more of a short-term investor, I'd probably be more inclined to look into the industries that were really badly hit in the coronavirus. I think they will have better short-term gains. So restaurants and airlines, I think they will have better gains in like a 5-year time frame. However, if you're a long-term investor like myself, I would definitely continue, which I'm doing, is investing in technology. And I think the COVID-19 situation has accelerated the world's transition to more technology companies. So I think they will be a better long-term investment, in my opinion, even though they're quite highly valued right now. So lastly, I'll just reiterate that we are definitely in a period of overvaluation in the market. So whenever you're buying a company right now, you have to be extremely careful that you're buying an excellent company that is more than likely going to be making a lot more money in the future than it is making now, and the valuation isn't absolutely astronomical. So just be very careful what you're buying and that you fully research the company. So if you enjoyed my analysis on the stock market, I'd hugely appreciate if you could smash the thumbs up button. If you haven't already, make sure to subscribe. I bring new videos out every other day. I really hope you enjoyed the video. I really hope you learned something, and I can't wait to see you in the next video. Thank you so much, and goodbye. Cheers.